Good evening. Welcome back to another episode of Great Men Profits for the advanced learners. And today we are talking about asset allocation so that we can build a successful portfolio. Let's get into it. First of all, you have to understand the relationship between an investor and a broker. Both people in this scenario want to make money. The investor wants to make money based on his investments, and the broker wants to make commission based on what he recommends. So, of course, he is going to be in the pursuit of making money. So, when he tries to sell you something as an investor, he is going to try and sell you an annuity, basically your yearly return in a financial year. He is going to sell you beta plans, a chance that you can leverage your money against how the market moves, so that if it goes up 10%, you might get 15, based that your beta ratio was a 1.5. But the same works if the stock drops. And then they're going to sell you availability. It's a fancy financial term for selling what is hot at the moment. If it's had a good run in the last month or so, they're going to recommend it to all their clients. It doesn't matter if it's going to stay up high or continue the trend. They make money off commission. And what does this come down to? If you follow all these three rules, you are going to go into the asset gathering. This is how brokers make money. They make money off commission and then monitoring accounts, whether they go up or down. So, how can we avoid this? Well, saying that we are going into a recession, you need to allow your portfolio to have both high income assets and low income assets. This is important and might sound controversial, but when shit comes down or push comes to shove, this is what is going to save your account. Of course, your high income investments are most likely going to be availability trends. So this is what the brokers are going to try and sell you. It is going to include high movement ratios, meaning that the stock moves around quite frequently. It has a great potential of growth, saying that it has a history of progressing at this percentage. A great example of this is the S&P 500. And then you have optimal returns, non-fixed, meaning that it might be great and it might be poor. On the other side, we bulk up our asset portfolio with low income assets, low movement or appreciation, low or stable earnings, meaning that no matter what happens, it is going to pay out this. And most of the time, the ones that have stable earnings are going to be suboptimal returns or fixed. The reason that we want to stockpile these is because, of course, when a recession comes in, the high income assets are the first ones that turn in the red. They were a more risky option, so their returns drop. And coincidentally, most of the time, the low assets increase, saving your portfolio.